Hey, good morning, everybody. Welcome back to another episode of Making Moves in Multifamily Live. My co-host Tim Vest is not here with me today, so this is the first time I've been flying solo on one of these podcasts in a while. So I'm a little excited about it because typically we have some great conversations, and we also have a lot of great guests in our podcast. But I haven't been able to kind of just get on here and talk about things on my own. And if many of you may or may not know, when I originally started the Making Moves in Multifamily group, it was just me on these podcasts for like the first 6 or 8 months. And then I brought in my lovely co-host, Tim Vest, and we have just been doing that ever since. It's been, I think next month is going on, is it 3 years? I think it's going on 3 years. We've been doing this show for 3 years. So hey, that's a win in my book. Cool. So, all right. Um, I wanted to talk about something because it seems like there's a big misnomer in the market right now. Hey, Dennis. Good morning. Good to see you, buddy. Um, I had recently posted about getting a couple properties under accepted LOI that Tim and I are selling, and there's been a couple people responding on some of those Facebook posts and assuming, hey, if you're selling a deal right now, you must be struggling. And that's just simply not true. And if you go look at any of those responses that I had made, it's like, I don't think any time in the real estate market is a good or bad time to sell, especially when you do what we do. I mean, for those of you that don't know, I'm a value add multifamily investor. I syndicate my deals. I do joint ventures and JVs. I buy property myself. I do everything, right? Syndication is just a tool in order to get deals done. And I don't believe that there's ever a bad time to sell, because if you calculate your forced depreciation and you're able to execute on that business plan, sure, property values have fluctuated. I'm not going to deny the fact there that property values have not fluctuated. There has been a decrease in property values. There has been a decompression or increase in cap rates. Um, there has been increased property tax assessments. There's had been increased insurance assessments. There have been increased things across the board. And I'm not disagreeing. There has been price reductions. But if we bought a property and we calculated what today's income was and what the future income could be, and we've executed on that business plan, and hopefully, I mean, all these people are saying I've been conservative, and I'm under promising and over delivering. Well, if you were doing that, then even baked in with your reduction in your prices and your values, you should still be able to meet pretty respectable returns. And I have to say, and I'll, pat myself and my partners on the back, most of our deals that we have sold, actually all of our deals that we have sold, have exceeded our average annual return on an annual basis. Now, some of those deals we estimated we were going to do a 2x equity multiple in 5 years. And the last two deals that we sold were equity multiple of 46% in 2 years. And another one is going to be 65% in 2 years. So the average annual return on the first one is 24% per year. And the second one is 32.5% per year. That's pretty incredible, right? So I get some people, I always like to ask them in that question. I'm like, well, would you rather have 2x your money in 5 years or 65% return in 2 years? And the obvious answer there is I'd rather have the 65% in 2 years, because now with the law of velocity of capital, I can redeploy that money into a new deal at a new stepped up investment basis. And now, instead of having, my $100,000 at work for 5 years, if I can realize a gain of 65%, so now I got $165,000 going back to work at the beginning of year three, then now I can look at doubling that money or getting a 65 to 70% return on 165,000 instead of 100,000. So I know maybe it's a little difficult to track, but I know I'm kind of thinking about it in my head as I go here. But when you can realize equity gains and exit a property successfully and take those gains and reinvest them into a new deal, that by definition is the velocity of money. And I am a big fan of realizing capital gains and capitalizing on the forced appreciation that you've created in order to exit a deal and put the money back to work. Now, you might say, Tim, that's not good, right? Or you might just flat out say, "Hey, like I don't agree with this model." And that's okay, right? Not my investment thesis versus your investment thesis might be different. Um and I would also challenge somebody and say it is not a good idea for somebody to buy and sell deals frequently unless you have a huge opportunity pipeline. If you have a huge opportunity pipeline, then you will have opportunity to invest your money into again. And the biggest risk or the biggest problem that you could have with doing more transactional stuff is that you run out of opportunity and your money is just sitting in the bank account. And I don't want to say doing nothing because you could put it into like a high yield savings account or an index fund or whatever, and it can earn 4, 5, 6% per year. But if you have opportunity lined up back after back after back after back so that you can take that money and reinvest it and you have no dead time in your money, like that is obviously going to be the most efficient and beneficial thing that you could do. Um, is that easy? No, absolutely not easy. Not everybody can do that. Not everybody has the pipeline. Not everybody has the risk tolerance to be doing that either. So buying and selling deals frequently is not for the faint of heart, and it is not easy, but it is possible. The fastest way to grow your wealth is to focus on growing your balance sheet. If you can grow your balance sheet, then you're going to be able to make more cash flow in the long run. And a lot of people say, "Oh, I'm a cash flow investor. I'm a cash flow investor." I'm like, "Okay, that's great. I understand." However, as your equity balance and your balance sheet continues to go up, the cash flow follows that, right? So like as you have more money invested, even receiving a lower return, your cash flow goes up, right? And if you want a practical example, say you want to make $100,000 a month. Well, in order to make $100,000 a month, you need to have $12 million invested at 10% paying out every month, right? That's 100K. You're making $1.2 million per year. That's your 10% return on your $12 million equity basis. If you still want to make the same level of money, $100,000 a month, but you want to put it in less risky deals, right? Because remember, returns are risk adjusted. So something that has a 10% return typically is going to be a more risky return than something that would be more stabilized. So the difference that I like to talk about is multifamily properties and in their different classes. If you're investing in like C class assets or D class assets, you're probably getting a little bit better than a 10% return per year in cash flow. But if you're investing in class A assets or triple net deals, you're more than likely not getting 10% return. You're probably getting somewhere between 5 and 7%, right? So, in order to make it easy math, if I were to take my $12 million and possibility of losing money is much higher than if I had grown my equity balance to $24 million and then invested into class A deals that were paying out 5%, right? But on that same equity basis, if I have $24 million paying out 5%, I'm still going to make the same $100,000 a month in cash flow, just more stable, less risk, more long term legacy assets. And I think there's a misconception where people are always talking about, well, I'm going to buy and hold everything I own forever. And I'm not saying that that's not a good business plan. If that's what you want to do, fine. But for most people, they're buying deals and they're using them as a pawn in order to create equity and create wealth. And if you're doing that, a lot of these deals, you don't want to own these deals long term, right? You're going to come in, you're going to do the renovations, you're going to get the value up to where you want to get it to, and then you're going to sell it with meat on the bone for the next guy so that you can successfully exit the deal. And that's why I don't think selling deals in 2024 is bad. We are on the two properties that we have accepted LOIs right now. We don't have to sell. Both of them have stabilized debt for the next 4.5 years. We don't have to sell them. But I'm also looking at the opportunity cost and saying, okay, well, I have a, a lot of equity in these deals, and my return on equity is actually pretty low because we've increased the value so much that if I refinanced it, my interest rate's going to be terrible, and it might not even make sense to refinance it because my loan to value constraints are higher or lower, right? So maybe my max LTV is like 65, 70%, or some of these assets we were buying at 75%. But coupled with that is maybe my DSCR constraint went up from 1.2 or 1.25 to 1.3, it's happening all the time, right? So in those same assets, if I wanted to look at a refinance, even though I've increased the value significantly, because my DSCR constraint has gone up and my interest rate has gone up, then it's going to make it so that my loan to value on a refi is going to be down. So we've actually come across this on another deal where we were not capped out on a DSCR basis. We were capped out on a LTV basis because the LTV max was like 65%. But at a 65% refi, our DSCR was like over one, I think it was 1.32. And I kind of struggled with that because I was like, well, it says in your loan documents that you can, you're constrained to up to 1.2. And it's a combination of the two. So it was a successful refinance. However, it didn't pull out as much money as we had wanted to because the lending environment is different. And with all that to said, it's like, okay, well, so now our investors didn't get 100% of their cash back. They got some money back, but not all of it. And it would have maybe potentially been better for that deal that we exited it and took all of that money and reinvested it into a new deal, right? And stepped it up because now we can do a value add process again and we can get the money moving. But ultimately, at the end of the day, it's not a bad time to sell it or a bad time to refinance it if you've increased the value. If you've completed your forced appreciation business plan, there's going to be equity on the table that can be refinanced and that can be had in order to increase your cash flow or returns from investor equity basis, which is a good thing, right? At the end of the day. And now there's no one size fits all. And I've said this before, and I know it probably sounds like a broken record, but there is no one size fits all. My business plan versus your business plan could be completely different. And more often than not, they are completely different, but that's okay. I mean, there's no wrong or right way to make money. The biggest thing is actually making the money. Another way to kind of compare it to is with the stock market, is people don't shame other people for taking capital gains, right? So realizing gains in the stock market. People always say that you should, once you've gotten to your number, you should sell. Okay. So why wouldn't you apply that same principle to real estate? If you've gotten to your number where you can make good money on the deal and you can take some investor equity basis off the table, you can realize capital gains, and you can make everybody happy and have a little dopamine hit of, hey, we made money, we didn't lose any money. Maybe you should do that because it's less frowned upon in the stock market to take gains, but it's more frowned upon to take gains in the real estate. And I think it's a crisscross. I think it's because in real estate, it is known to be a long-term buy and hold. Like, it's a long-term business plan. You're investing in for the long run. And that's true on legacy assets. And I'll challenge you and say that that's not true on these value add deals. If you look at a house flipper, for example, yes, every deal that they are flipping, they are selling for equity and they are making money on it. They could have refinanced every single one of those deals and kept them forever and made a lot of money over the long run. But if you tracked the money from the sales and you said, well, look, this guy made, $30,000 on these three flips and turned it into $90,000. Well, now with that $90,000 basis, maybe he can go do five flips. So if you track the money for what you've done with the money since your sale, I'm sure you're doing better off in the long run as long as you continue to have your opportunity and that you can continue to reinvest that money into new deals and keep the velocity of money moving. That's what I'm all about. I'm all about keeping the money moving, realizing your gains, and taking some risk off the table. If you've created equity, realize it. And then nobody's gonna be upset about making money, right? Now, you might have some people that are upset because they didn't want you to sell as soon as you did, but if as long as you have an opportunity for them to reinvest their money into, no harm, no foul. Not only are they making money, they're stepped up into a new basis. Their cash flow is going to be on an absolute dollar value is going to be higher. Maybe percentages are lower, right? Go back to our example of the 12 million versus $24 million of equity investment basis. Maybe your return percentage is lower, but your absolute dollar value is higher. That's a good thing in my mind, right? Because you're going to make more money at the end of the day. And it's kind of this. It's a give and take. It absolutely is a give and take. There's no right answer here. And it is, evaluating what's right for you and your circumstances. But I don't think now is a bad time to sell. As a seller in 2024, it's interesting to see some of the offers that we've gotten and some of the feedback that we've gotten from brokers is that, oh, well, these guys must be struggling. They must be forced to sell. And it's fun every time I have a conversation with our broker, it's like, hey, make sure you tell that, make sure you make it clear to these guys that are the potential buyers that we're not pressured to sell. And this isn't you can call me on my bluff, right? But I'm not bluffing. We don't have to sell these deals. But if there's a good opportunity that comes up and we can sell these opportunities and make the money that we predicted or better, right? And if we predicted that we were going to make a 15 to 18% average annual return and I'm able to deliver a 25 to 35% average annual return in 2 years instead of 18% over 5 years, it makes sense to do that. Um, because now if you look at it, first for easy math, if I underwrote a deal and I presented it and said, hey, we're going to do 15% average annual return per year, but over 5 years, that would be whatever the return is going to be. Or I could say, we had an opportunity to sell this deal and we're going to realize a 30% per year average annual return, but it's only going to be for 2 years. Now you're making a 60% return instead of 30 in 2 years. So it obviously makes sense to do that because you're essentially buying you're essentially realizing the gains that you would have gotten in 2 years faster. So you're moving that money so much faster. You're making money on that money so much faster, which is a good thing. But yeah, so it's important to know that you are portraying that you don't have to sell these deals. And in 2024, there have been a lot of headlines of people selling deals, losing money. Like what was that? It was like the Apple Tree or Applegate, something. Applegate. There's always that. Sorry, I'm a Patriots fan, and it comes back to Deflategate. But anyways, those properties down in Houston, like there's been a ton of property up in Houston or down in Houston that has been going into foreclosure because these guys bought it with bridge loans with no rate caps and this, that, and the other thing. Those guys are forced to sell, right? So you might be able to get a good deal on those deals because they have to sell. There's another one that's in the Carolinas that's been going around, GVA. A lot of that portfolio is up on the chopping block. I think he had like 30,000 units that he's in foreclosure on now. Those are the opportunities that you can make lowball offers on because he is a distressed seller. We are not distressed sellers. And it puts you in a position of power to sell an opportunity when you're not a distressed seller. That is the most opportune time to sell a deal when you're not distressed. Let that sink in for a second. Like you're not a distressed seller, so you're not going to make a rash decision. You're playing the field, if you want to call it that way. You're seeing what offers you're going to solicit. You don't have to sell it, but if the right opportunity came along, yeah, I'd probably sell it. That's a really good position to be in. It's a very low stress position to be in. And I like low stress positions. I don't know about you guys, but being in a low stress position is definitely something that is good for my mindset. It's good for my health. It's good for my investors. It's good. It's good for everybody involved because there's no pressure. When you apply pressure, rash decisions get made quickly because you have to make a decision. And I don't know. I'm a big fan of selling deals in 2024. There's another thing that I'd like to talk about selling deals in 2024 is a lot of people will say, "Show me your track record." Okay. Hey, I mean, I don't know how many people have heard that. I'm sure people in the comments have heard, show me your track record. I want to see what your track record of your deals were. And I would challenge somebody and say, does it really matter what my track record was in 2019 to 2022? Because we were in basically the biggest growth period of a real estate cycle we've ever seen. And anybody who bought a deal could list it for sale a year later and make money on it, right? If you don't think that's true, challenge me on it. I'd love to have you challenge me on that. But if you do think it's true, think about all of the opportunities that are being sold right now in 2023 and 2024. I would say, it doesn't really matter what my track record was in the good years. Let me show you what my track record was during the difficult years. Because if you're able to buy a property and sell it for gains, for capital gains, and make money on these deals during the down swing of a cycle, you, in my opinion, are a much stronger operator, and or you actually were conservative in your underwriting when you bought this place. You actually did decompress your cap rate. You did back off of your potential rents. You did increase your expenses so that you have wiggle room across the board. Now, you operate it really really well, and you were able to meet those expectations or maybe even exceed those expectations, and you're able to sell it for gains in a down period. That to me screams, it says so much more about a potential operator's value and um their skill set than if you showed me your track record when times were good. Because all of these properties that are up for sale for foreclosure right now, all of them were bought in 2019, 20 or 2020, 21, 22 more specifically, right? Because now we're in 2024. People that were buying in 2021 with 2-year bridge loans, they've exercised their 1-year extensions with this survive to 25 mentality. But you're seeing all of these people having to sell these properties because it's not getting any better. And, me too. I was hopeful that we would start to see some Fed reduced rates by June 1st. I've been saying that since like Q3 of last year. When they stopped increasing the rates, but I don't think it's going to happen anymore. I'm hopeful for 125 basis point reduction, but I think with the latest trends, inflation is still higher than what the Fed wanted. I know that they have this 2% target, and I think the Fed rate, I think the inflation rate was like 3.1%. So we're not quite there, but I think it was trending up. And if it's trending up, you're going to have an increase in Fed. And thankfully, I don't have any variable rate debt. I don't believe in doing variable rate debt. All of our loans are fixed. And, it's funny to see, we bought some deals like 4 to 6 months ago. And even the lending broker was like, we think rates are going to go down. So we would advise you to get a variable rate bridge loan. And I'm like, no, I'm not even putting that risk. If I were a betting man, yeah, I would bet that the rates are going to go down. But when I'm using other people's money, I need to have security. And when I'm underwriting my deals with fixed rate debt, I know exactly what my debt is going to be, and that makes me able to predict and better underwrite my deals for how much reserves we need in order to make sure the deal is successful. If I'm counting on the rate to go down and it doesn't, then I'm left in a really bad spot. And I'm super thankful that we didn't take any variable rate debt. Tim Vest and I, we stuck to our guns. We said, no, no, we are not doing fixed rate, or we are not doing variable rate debt, despite what the general consensus is that rates are going to be going down. We want the fixed rate. We will pay more for fixed rate now to be able to accurately predict our reserves and how our deal is going to perform than take variable rate debt and presume that the rate is going to go down. Because it could go up. And I think there's a lot of sentiment in the market right now that some people do think it's going to go up. I think there is a possibility. I have been hopeful, in a full disclosure, I've been hopeful for some rate reductions. Everybody across the board has been, because there's a lot of deals I would love to refinance if the rates were better, but it really doesn't make sense to do that. So I'm looking at sales because I've increased the value and there's a lot of equity sitting there that I can redeploy the equity into new opportunities. But I would love to be able to refinance some of this stuff and just hold it long term. But it doesn't really make sense to do so when your ROE is less than 7 or 8%. It's like, well, let me move the money somewhere else that I can put it into making 15 to 20% on an average annual return basis. Yeah, so Dennis, great point. Selling deals, especially if there's meat on the bone for the next buyer. Full disclosure, I learned this the hard way. I bought a deal and I renovated like basically 100% of the property, and I got most of the rents up to market rate, and I can't sell it for what it's worth. People are not willing to buy it because they say that there's no meat on the bone left for them. They said that it doesn't create enough money for them to buy it. So ultimately, what's happening now is I'm stuck with this property that's performing extremely well, like incredibly well. I'm super pleased with it, but I can't sell it and realize those equity gains because there's not enough meat on the bone for the next guy. So now I'm going to end up probably holding it for another 6 months or 12 months, hopeful that some rates are going to come down and that insurance rates are going to come down, which is going to increase the NOI, but then still being able to sell it for what I could sell it today because it's going to create meat on the bone for the next guy. So, being able to sell something is vitally important. I think it's been lost. I truthfully think it's been lost. Um, when I got into real estate, and I mean, I think when most people got into real estate, uh, one of the most important things that people kind of pointed at was make sure you have multiple exit strategies. I know everybody has heard that before, multiple exit strategies. And it is very important to have multiple exit strategies. Um, However, I didn't consider my exit strategy to be selling it with meat on the bone. I thought I have to maximize this potential as much as possible so that I can make the most amount of money out of this deal, and that's a good thing to do. However, it makes it very difficult to sell something because it doesn't allow the next guy to make money. So what have I done from that is I have now, whenever I go to sell a property, I look at it as a potential buyer and I would underwrite the deal as an acquisition. So that way I know where I should price my deal at, or at least how I should advertise it and who I should advertise it to, because I know what my exit strategy is going to be, and I know what it looks like as an acquisition for the next person. Does that make? I hope that makes sense because, if you're not looking at it from somebody else's perspective and only your own, it's I would say that that's pretty short sighted. Where you could be leaving opportunity on the table because of your opportunity cost lost of not being able to exit a deal for money, right, to realize your gains and sell it to the next guy that can also make money. Because it doesn't matter how much you push the value of a property. If you can't exit those, if you can't sell it, you can't realize those gains at the end of the day. And that is crucially important to being able to growing your balance sheet and growing your net worth. Um, Yes, there is a level of, well, my net worth is representative of the asset value minus my liability. That's true. However, it's not going to continue to grow as rapidly as it could if you don't continually move the money around. The value of the property will go up. Your equity pay down will happen through amortizing loan payments, and you will make money in the long run. But I want to make as much money as fast as possible. I'm not really interested in those long term legacy assets right now because I have the time, energy, the team. We self manage. We, Vive Equity, Vive Property Management. We self manage our own assets now. We have, an amazing team that works with us that works really, really, really hard. And while we have that team, I want to make sure I capitalize on that opportunity as much as possible because we have I don't want to say an unfair advantage, but we have an advantage in the marketplace that we have these systems and processes built out where we can capitalize on more deals and realize more equity gains faster because of the speed that we're able to execute our business plans having an in-house management company. So all right, that's enough for me on my soapbox today. I hope you guys got some value out of this. I I really wanted to be transparent in this regard because um, it's different. It goes kind of against the common grain thought of what you should and shouldn't be doing and what's going on in the market today. I hope it brings a different perspective for a potential buyer or another seller out there to kind of consider things a little bit differently and challenge the status quo, where one size doesn't fit all, and there's always reasons or arguments for both sides. So I just wanted to kind of show you my side of what it looks like in the day-to-day life of Tim Vitale and why we look at selling assets instead of refinancing and doing that kind of stuff. So all right, without further ado, I appreciate everybody joining today, and I will see you next time. Peace.